In this video, I'll be explaining Forex basic. You understand? This is your guide in understanding what Forex is all about. This is your beginner's guide, right? So if you don't really know what Forex trading is, now in this video, I will explain everything from scratch to your understanding. So you're going to be understanding everything about Forex trading and how you can get started with Forex trading. So if this is your first time hearing Forex trading, even if maybe you've heard Forex trading before, but you don't really understand what it is, well, this video will break down everything for you. All I need is your attention. You understand? I need you to get pen and a book and be taking note of everything I'll be telling you in this video, because you will need it in order to become a profitable and professional trader. So let's get straight into it. So like I said, this video would help you to fully understand what Forex trading is all about and how you can easily start making money from the Forex market. We'll be looking at all these concepts, which is definition of Forex trading. We'll be looking at what currency pairs are. We'll be looking at what Forex market structure is. We'll be looking at the key Forex terminologies, the types of orders, types of analysis as well. We'll also be looking at risk management. We'll be looking at trading psychology, Forex brokers and platforms. We'll be looking at demo versus live trading, and also we'll be looking at building a trading plan. This video is packed with a lot of information, a lot of knowledge. So I don't want you to get overwhelmed. The only way you can understand it is if you're taking note of the important points. So let's go straight into it. So before we go into this, remember to be taking note, like I said, of everything I will say in this video, because you will need to understand it all, as this is your first step in becoming a profitable Forex trader. You understand? So I need you to become good at trading, and the only way you can become good at trading is baby steps. This is your baby steps. This is your baby steps. Understanding what Forex trading is really all about. Now, some people might feel like this is not important, but I'm going to tell you this is the most important step when it comes to Forex trading. Understanding these little informations, these basic information, because you cannot just jump into learning a strategy without knowing what Forex is all about. You cannot just jump into making money without knowing what you are really doing in Forex trading. So let's get straight into it. What is Forex trading, first of all? So I want you to understand that Forex markets, also known as foreign exchange, is where currencies are bought and sold. Take note of currencies and then the points bought and sold. It is the largest financial market globally, with over $7 trillion traded daily. Now, the Forex market has a lot of money in it, right? And it is where different currency pairs of different, countries are being bought and sold. You understand? So that is the main point I want you to take note of. In Forex trading, what do? We simply buy or sell currencies. We simply buy or sell currencies. Now, Forex trading is like exchanging your money when you travel to another country. For example, if you go to Europe and exchange your dollar for euros, you've done a basic Forex transaction. In Forex trading, you are doing the same thing but online. And instead of just traveling, you are trying to make money from the changes in currency prices. Now, just like when you convert your dollar or your naira to dollar, right? You're simply doing Forex transaction. Why? Because you want to make money from the change in price. Do you understand? You want to make money from the change in price. Let's say you heard dollar is rising in value and you had naira, right? You use your naira to buy dollars, so that in case dollar keep rising, that your naira will also increase in price when you finally convert it back to naira. So Forex trading is just simply all about buying or selling currencies. And now I know you might be confused, right? But trust me, that is simply what we do. Now, so we simply buy or sell currency pairs in Forex. Now, what do I mean currency pairs? Currency pairs just simply means two currencies that are paired together. For example, you have Euro and you have USD. When it's paired together, it's called what? Euro USD. And now in Forex trading, we just buy or sell that currency pair. right? So we buy when that currency pair is moving up to make profit, or when we predict it to move up to make profit, and we sell that currency pair when it's moving down to make profit also from the movement. You understand? So when I mean buy and sell, this is just simply what it looks like. There is just a button. You can see this image I sent. This is what the buy and sell look like. It's just a button you press, right, to make money from the forex market. We simply buy or sell, and it's a simple button. You get? So it's not even complicated. It's not like you go to a market to buy or sell anything. No, it's just an app and a button. You press it when you want to make money from, a currency pair by buying it or by selling that currency pair. You understand? I use the word "or" because you cannot buy and sell one particular currency pair at the same time, but you can either buy it or sell it. So now, why do we trade forex? Well, simple. It's accessible, right? 24 hours and 5 days in a week. I said 5 days in a week. Why? Because the forex market closes during the weekend. Take note. The forex market closes during the weekend. So it's accessible 24 hours, right? You can access it 247 throughout the day. And Mondays to Friday, you can trade the forex market. Secondly, it has high liquidity. Now, the term liquidity just simply means money. It has high money. You understand? It has a lot of money. So we want to make some of those money from the forex market. Also, you can start with low capital. You understand? You don't need billions to start trading forex. You can start with as low as $20 and you make huge amount of money with your $20. So it has opportunities for profit regardless of the market direction. Remember, I said something earlier. We buy when the market is going up to make profit, or we sell when the market is going down to also make profit as well. So you can make profit from different market direction regardless of the direction. It's not like crypto that if you buy a cryptocurrency, maybe in spot, and then it start dropping in value, you'll be making losses. No, this one is different. You can just easily buy or sell any currency pair. That's the beauty of forex trading. So that is why we trade forex. So let's go into currency pairs. Explain. Now remember, I said we buy and we sell, or we sell currency pairs. Forgive me, not and, or. So forex trading always involve two currencies, like I said earlier, called currency pairs. For example, I also use this Euro USD. Euro is a currency on its own. USD is a currency on its own. Combined together, it is called Euro USD. Another example, we can have GBP USD, right? British pound dollar. You understand? So if you combine both of them together, it is different currencies but as one, known as currency pairs, and that is what we simply buy in forex trading or sell in forex trading. So there are different type of currency pairs. They are the major, they are the minor, they are the exotic pairs, right? So major pairs are the most traded pairs in forex markets, right? The major pairs are the ones that contain USD. Mostly USD. So you see Euro USD, you will see GBP USD, you understand, you will see USD CHF. Those are all major pairs. Why? Because they contain USD. Now minor pairs are the ones that do not contain USD. You have Euro GBP, we have AUD NZD, right? All these are minor pairs. Now why do we trade mostly major pairs that contain USD? Well, it's because there is volatility in USD markets. You understand? Most pairs that are paired with USD has high volatility. Now, what is volatility? I know you might be saying, what is volatility as a beginner? It's just simply when the market is moving very fast or is moving in a nice way in which we make money from it. We don't make money from a stagnant market. We make money from a market that is moving constantly. So when the market is moving constantly, it's called volatility. So we also have exotics. So involve only one major currency and one from an emerging market. Now, this exotic is something that I don't even advise my students in the academy to even look at all. You can trade majors, you can trade minor, but don't even go to exotic, because don't worry, you'll be finding out why as we go on. Now, I want you to understand that currency at the front is called the base currency. Remember, there are two currencies in a currency pair. And in forex, we buy or we sell currency pairs. Now, the currency at the front, which is The one at the front of the two currencies that are paired together is called the base currency, and the currency at the back is called the quoted currency. Did you understand that? The currency at the front of the two currencies paired together is called the base currency, and the currency at the back is called the quote currency. Now you can look at this image I sent below. You can see this image. There are two currencies in this image, which is a currency pair, USD and what? GBP. Now USD is known as the base currency, and GBP is known as the what? Quote currency. You understand? So if I'm asking this question, right, which of these is known as the currency at which you're going to sell? Remember, we sell the one at the back, which is the what? Quoted currency, and we are buying the one in the front, which is the base currency. Take note of this, right? The base currency is the one we are buying, and the quoted currency is the one we are selling in forex trading. Very, very easy. Forex trading is actually very easy. All we just do is buy or sell currency pairs. You understand? So market structure is the natural flow of price movements in a market. It shows how price moves in patterns, helping traders to identify trends and make decisions. Now, if you're just hearing trend for the first time, I'll explain it to you. So think of it like reading a map that shows you where the market has been and where it might go next. So market structure helps us to understand where the market will go next. You get? So remember, we make money from forex by simply buying or selling currency pairs, and now we buy a particular currency pair if it's moving up in value, and we sell a particular currency pair if it's going down in value. Now market structure help us to identify or make our decision based on past movement of the market. It help us look at the market and tell if this market is going to go up or if this market is going to go down. So we make money in forex by simply understanding and analyzing where market price is heading to. And there are three possible price movements, which is the upward direction, which is an uptrend. We call that an uptrend. The downward direction, we call that a downtrend, and the sideways direction, we call that a sideways trend. I want you to take note of this. Very, very important. So when the market is moving up, it's called what? An uptrend. When the market is moving down, it's called what? A downtrend. And also when the market is moving sideways, it's called a sideways trend. Very important. This is the only three directions the market can make, and you can make money from these three directions as a forex trader. I would show you how as we move on, right? For now, this is just the basics for you to understand. So forex market section, I want you to understand that market section are just simply the time of the day at which we are trading the forex market. Well, Sunday is known as the start of the day. It has low activity. Now Sunday for a Nigerian is known as the night period, right? Your 12 a.m. is known as the Sunday. That is when the day starts, 12 a.m. You understand? It's known as the night period. It has low activity. Low activity can also be called low volatility. Remember what I said? What volatility is when there is high movements in the forex market, and we only make money from forex trading when the market is moving, when it has what? High volatility. You understand? You're already getting a lot of things. You're already, by just knowing all this, you're already good. You understand? So I just need you to be taking note of it. So this is known as a moderate move. Focus on JPY. Now I said focus on JPY because there are pairs in which you can trade during this section. It's not all pairs you can trade during this section, right? Some currency pairs are shut down due to their banks are closed during this section. Now what do I mean bank? Why am I bringing bank into this? So for we Nigerians, we have a particular time in which our banks open, and we have a particular time in which our bank close, right? So from that point where our bank open and when our bank close, you can trade our currency. Let's say our currency was in the forex market, you can trade it. Once our bank closes, you can't trade at all. The forex market itself will close. You can see, so forex trading is actually related to a lot of things. There are a lot of big players when it comes to forex trading. Your central bank is one of them. So some currencies, some countries, this is their opening time, this is their opening date for their bank. You understand? So for Tokyo, JPY are known to be the opening time for, JPY pairs. You get? So you can trade JPY pairs during this period, and it's for us Nigerians, this is known as a night time. You understand? This is known as a night period. You get? So for London, now London section is known as the most active section with major currency pairs. Now remember, what are major currency pairs? Major currency pairs are those that have USD in them. So I want you to understand that the London section is the best time to trade those USD pairs. Why? Because they have high volatility. And when is this London section? For us Nigerian, is known as early in the morning, from 8 a.m. all the way down to 4 p.m. London section is open. You understand? London section is open. So for New York section has the highest volatility, especially when the two sections are combined together, because New York section opens by 1 p.m. right? Once they open by 1 p.m., London section is still open by then. So this is a combination of two trading sections. And that is why it's good to trade during this period. Why? Because the market moves very fast. There is high volatility. So just seeing that forex trading is actually easy, right? There's nothing complicated about it. Number one, first of all, we buy or we sell currency pairs. Second of all, those currency pairs, they are known to be two currencies combined together. The front one is known as the base. The second one is known as the quotes. We buy the base currency and we sell the quoted currency. And now these currency pairs are known to have time at which their banks open, which makes it more easier to trade them. So if you're trading a particular currency pair when the bank is open, you're going to be making money from that particular currency pair. Why? Because the currency pair will have high activity. And we simply buy when the market is going up, sell when the market is going down. Very simple, very easy. Now let's move on. So now we're going to be looking at key terminologies in forex trading. The first one is pips. Now what is pips? Pips stands for percentage in points, or price interest points. It is the smallest unit of price movement in most currency pairs. Now I want you to know that every currency pair has a value. It has a price at which you're buying it. It has a price at which you're selling it. You understand? So the price at which you're selling that particular currency pair can be calculated in pips. So how does it work? Most currency pairs are quoted to 4 decimal places. We have 1 pip in the 4th decimal place. Now the pip is the last decimal value in your currency pair. For example, if Euro USD move from 1.1000 to 1.1001, that change in that 1.100 to 1.1001, that one is known as 1 pips. We are calculating the price change in Euro USD now. Remember I said every currency pair you're buying has a particular price at which you're buying it or selling it. You get? So now we calculate that price using pips. You get? So for one pair, for some pairs, right, we only have 2 decimal places, like the USD JPY. So it's not all pairs that have 4 decimal places. So 1 pip is the 2nd decimal place in USD JPY. For example, USD JPY moved from 145.00 to 145.01. That one, you see, that change is known as 1 pip. Why is it important? Well, pips is how we calculate profits or losses in forex trading. The number of pips you gain or lose determines how much money you make or lose in the market. It's as simple as that. Right? Very, very easy. So what is pips? Pips is just pointing percentage. It helps us calculate how much we're making in forex trading or how much we are losing in forex trading. You get? So once price adds in value, it adds by a pip. You get? So let's go into more basic. Bid price is the price at which you buy the base currency. I don't want you to look at this. What I wrote here is actually wrong. While ask price is the price at which you sell the currency. So the difference is between bid and ask is which broker are you using? Which broker makes the money? You understand? So the difference between bid and ask price is known as spread, and spread is the money in which the broker makes. I don't want to confuse you, but just know that the bid price is the price at which you're buying a particular currency pair, and the ask price is the price at which you're selling a particular currency pair. So this was a mistake on my end. This one I wrote, but I want you to look at the image while I'm explaining, right? Euro USD is the base currency. Now, Euro USD has a particular value which is 1.15280. Now, that price of Euro USD, which is the base currency, is known as what? The bid price. And if you're going to buy Euro USD, you're buying Euro USD at that price, which is the bid price. Now, USD itself is known as the quote currency. Now, if you're looking at USD itself, look at the back, you can see the price of USD. USD have 1.15290. Now, the price of USD, which is the quoted currency, is known as the ask price. Now, if you're selling, remember I told you that we buy the base currency and we sell the quoted currency. Now, if you're selling USD, you're selling at the ask price. You understand? Now, the difference between the ask and the bid price is known as what? Spread. And that spread is determined by your broker. Brokers, you understand what brokers are? Brokers are, platform at which you deposit your money to trade. You understand? So they are making percentage from each trade you place. So the difference between that your buying price and that your selling price is known as spread. And this is simply the money that your broker will make, right? Your trading platform will make. So think of it like exchanging your money at the airport. You buy at a higher value and sell at a lower value. That is just simply it. I hope just look at this image to understand it perfectly. You understand? So let's move on. We have spread. Like I said, spread is the difference between the buy price and the sell price of a currency pair. It is essentially the cost of entering a trade, and it's simply how brokers make their money. Now, I want to emphasize more on spread. If you buy Euro USD, you're starting with a small loss of 2 pips. Understand? Don't worry, you understand this. Now, that loss is not like it's your fault. It's just what the broker is making, because you are buying at a very high price and you're selling at a low price. You understand? So the difference is known as spread, and that spread is what will make you, once you place a trade, the first thing you start seeing is loss before you start seeing profit. Don't worry, when you go into placing a trade, which I also made a video on, you would understand it perfectly. So the spread is just the commission that the broker takes from each trade you place. You understand? And it's the difference between the bid and ask price. So let's keep going. Now, what is lot size in Forex? Now, lot size refers to the volume or amount of currency you are buying or selling in a trade. It determines how much of a currency pair you are trading and how big your potential profit or loss will be. Now, what I just want you to take note of is Forex. In Forex, we mostly talk about lot size as a trader. You have to understand what this lot size is all about. Now, lot size is just simply what allows you to either make more profit from the Forex market. To give you potentials to make more profit, but at the same time, if you're doing the wrong thing in the Forex market, you will lose more money. You understand? It's actually a setting, right? And there are different type of lot size. We have a standard lot size, which is 100 units. We have mini lot size, which is 10 units. We have micro lot size, which is 1000 units. So how it affects your trade? Well, like I said, the bigger the lot size, the bigger the profit or loss. Example, if Euro USD move for 1 pips, you make or lose more money with a standard lot size compared to a macro lot size. For example, let me explain this in a very easy, understandable way. Lot size is like a setting in your trading app, which I will show you in future video. I will show you the setting, right? The lot size allows you can easily increase the lot size. Now, when you're increasing your lot size, it means you want to make more profit from this trade. No trader ever increase the lot size because they want to lose more money. No, the aim as a trader, the aim of increasing your lot size is to make more profit from that trade. So let's say you're using a lot size of 0.2 and your friend is using a lot size of 0.1. Who do you think will be making more money between both of you? You, because you're using a lot size that is higher than that of your friend. It's like a setting. So if you enter the same trade with your friend and your friend is making $10, you on the other hand, you'll be making $20, but the same trade. That's why you see some people make billions with just one trade. This is the secret. They change their lot size, they increase their lot size to a very, very high value. Now, what I usually tell my students, right, my students in the academy, I tell them that you don't increase your lot size until you have completely understood what forex trading is all about. And this is when you are trading a live account. You understand? So as a trader, if you just go into increasing your lot size because you want to make money, you're gambling. You have to understand everything in forex trading. You have to understand why you're buying. You have to understand why you're increasing your lot size. You have to understand a lot of things. There are a lot of things to understand in forex trading. You get? So as a beginner, I usually advise my students, as a beginner, don't look at that lot size, don't look at the profit you're making, just focus on the learning process. And when you finally have gotten everything, you've gotten your strategy, you've gotten your edge, you've gotten your trading psychology intact, I'll be talking about that in this video as well, you've gotten your risk management intact, then you can increase your lot size and make huge amount of money from the forex market. Forex trading will give you a lot of money, but you have to be patient to learn first of all. If it was that easy, everybody be doing it. If it was that easy, everybody be doing it. So that is why you have to be patient to learn first of all. So let's go straight into the next key terminology, which is leverage. Now, leverage is the tool that allows you to control your larger positions. So with small deposits. So for example, like I talked about lot size. Lot size is a setting which you can increase. Now, why can you increase that lot size? Why? It's because of your leverage. Take note, they are connected. Leverage is what allows you to increase your lot size. So the higher the leverage, the more you can increase your lot size. So if you're trading with a leverage of, because the leverage actually, you will see it in ratios. You see it in 1:100, 1:500, 1:1000. If someone is using 1:500 and you're using 1:100, and you want to increase your lot size to 0.50, the app you're trading might tell you not enough money. Why? Because you don't have enough leverage. Why the other person that using 1:500 can increase his lot size to 0.5, or really call it 0.50. Do you understand? So the leverage is what allows you to increase your lot size. So as a trader, if you want to increase your lot size in the future, you have to pick a high leverage. Now, what does leverage just simply do? Leverage just simply make your small capital look like a big money in the forex market. During 2007, let me just say this short story. During 2007, there was nothing like leverage. So you have to have a huge amount of money in the forex market before you can make huge amount of money. That's why some people ask me, does capital matters when it comes to making forex and making big money in forex trading? I tell you, it depends. It depends on your leverage. You can use as low as $50 to make $1,000. No cap. I am not trying to sugarcoat anything here. You will see it happen live and direct. Don't worry. For those who has my WhatsApp contact, you will see it happen live and direct. On my status, I post it. You see my students doing it live and direct. So leverage is just something that allows you to make huge amount of money with your small deposit. Even if it's $20, you can use that $20 to make $500 in one day. Depends on your lot size, and also depends on what your leverage. So margin is the amount of money needed in your account to open a trade. So margin is just simply how much money you have in your trading account that you need to open a particular trade. You understand? So we have type of orders. I want you to take note of this one because it's very important. As a trader, you have to be setting orders. So we have market orders, which is buy or sell immediately at a current price. So when you're buying a particular currency at a particular price, it's known as a buy order, right? When you're selling a particular currency at the current price, take note of the word current price, is known as a sell order. Now we have limit order. Limit orders are when you set your order in a position in which the price hasn't gotten to yet. You're trying to set a position. Let me use a drawing to explain it. Let's say this is your market. Remember, another thing I want you to take note of is that the markets move in a wave-like pattern like this, right? So let's say this is your market and you are willing to buy here. You are willing to buy here, that green zone I drew. So what are you going to do? You are going to set an order here on that green zone, saying that if market should get to that green zone, you want the market to put you in, and carry you along if it starts going up. That is just simply what you're saying. So once you set an order there and the market gets to that order, automatically you enter the trade. You understand? So that is called a limit order. That is called what? Limit order. You are not entering the market immediately. You're waiting for the market to get to that price before you actually enter, either on a buy or on a sell. And not in this video, I wouldn't teach you in this video, but trust me, there are different type of limit orders. You get? But let's go straight into what we are learning today. That is just the basics, right? So we have stop loss order, the most important order as a trader. Now automatically this closes your trade at a particular limited loss. So forex trading, I see people say forex trading you lose a lot of money. You only lose a lot of money if you don't have calculated losses. For example, in a trade I want to make $10, right? I will calculate my losses. I will say, okay, I want to use $2 to make $10. Now when I say I want to use $2 to make $10, it's not like I'm using my capital is $2. No, I want to risk $2 to make $10. Means if that trade doesn't go well, I lose $2. But if that trade should go well, I'll make $10. Are you seeing how easy it is? So even if I lose that $2 two times and I finally make that my $10, I'm leaving the market with profit. Why? Because I'm using a calculated loss. So forex doesn't, it doesn't finish your money. It's you that don't just have a good, proper calculated risks. We'll talk about risk management as we move on in the class. There's a separate video for it. So this is stop loss order. This is an order in which you set in every trade you take in order to limit your losses. If you don't set this order, when the market is going against you, you will keep losing and keep losing and keep losing until your account finally turns zero. So that is why this is very important. Stop loss, you set it in every trade you take. Stop loss. Now take profit. Now take profit order is an order in which you set when you want the market to hit your profit zone and take you out. You understand? Let's say you, like for the example I used earlier, I want to make a $10 profit. I've already set my profit target at $10. That once market gets to $10, I'm leaving the market with that $10. You understand? I don't want to be too greedy. It's also very important, but not as important as stop loss. You understand? Not as important as stop loss. Let's keep going. So we have entered the type of analysis. Very, very important type of analysis. You have to know this as a forex trader. Now the first one I'll talk about is fundamental analysis. Now this is the type of analysis in which trader uses news release or economic events to predict the direction of the market, and we use leading indicators to predict price movement and direction. Now most traders I know, like 70% of traders, they run away from fundamental analysis. But the thing is, I take my time to teach my students fundamental analysis. Why? Because you cannot run away from economic events. You cannot run away from news. These are the things that make a particular currency rise in value or make a particular currency fall in price or fall in value. Your economic events, the way the economy is going, the way everything is going, the way news is being released, it actually plays a big role in forex trading. But most traders want to run away from it. They want to go straight into making money from technical analysis, and I'll explain what technical analysis is all about as well. But I'm a very big player when it comes to fundamental analysis, and I also encourage my students to go and learn fundamental analysis. Be good at it. Be good at knowing when a particular currency will rise in value, and also know when a particular currency will fall in price. This thing will increase your profitability rate. You get it will increase the amount of profit you make in forex trading. Why? Because you can detect when a particular currency would fall in price, and you can sell it on time, and you can detect when a particular currency will rise in value, so you can buy it on time. So we use key indicators. Now we call it indicators. Why? Leading indicators, because they are indicators that are, that tells you or that gives you numbers. Now those numbers will tell you if the economy is doing well or if it's doing poorly. So those key indicators, we have interest rates. Now this is set by central bank. We have economic data, which is influenced by GDP. You will get to understand this when I teach you all fundamental, because I have a separate lesson on fundamental analysis. You will learn all that. So I'll also make a video on it. We have GDP, we have inflation, we have employment reports. These are all economic data. We also have political events and global news. You understand? Like example, whoever wins an election can also affect your trading. It can affect how much a currency pair move. You understand? So like for example, when Trump won the election, you can see USD rise in value, skyrocketed. Like USD started going very high in value. For those who traded Forex at that particular period, you can see how high USD was moving. Now for those who know how to use fundamental analysis, you know that okay, once Trump should win, we know that USD will actually rise in value. We buy it on time and we make money from that. So it's that easy. Technical analysis. Now technical analysis is the one all Forex trader know. This is the strategy. This is the one you see all Forex trader posting online about their strategy, about this one, about that one. But I want you to stand out, right? If you're watching this video, trust me, you're in the right place. I want you to stand out. I want you to learn fundamental as well. Don't join the crowd. Joining the crowd only makes you average. I want you to be different. I want you to also learn fundamental analysis. So technical analysis is just simply using previous price data to forecast or predict price market movement. So we use what the market have done in the past, right? Remember, this is when I say market, this is what I'm talking about. All these things you see when the market is moving like this, that is what I mean. So this market now, you can use this past movement, right, to dictate what the market will do here. You understand? So that's just what it simply means. So we use common tools like support and resistance level. All traders know this, or beginner traders should know this, and you'll be taught this as well. We use price points where markets tends to reverse or stall. We also use indicators. Now I'm not a big fan of indicators, right? Indicators are just there for me. But as a trader, if you want to learn indicators, sure, there are a lot of ways you can learn it. There's RSI, there's MACD, there's Fibonacci retracement too. All these are good indicators in which can help you predict where the market is heading to next. So we have risk management. Now risk management is a very, very important aspect when it comes to trading. This is the part in which determines if you would lose all your money in Forex trading or if you make more money in Forex trading. You can lose $2 today and come back to fight another day in your $10 account. But if you don't have a good risk management, you can lose that $10 ASAP in just one day and you don't have any money to come back to fight another day. So you using a good risk management will help you protect your money while trading. It involves setting limits on how much you are willing to lose on each trade and making sure you are not risking too much on a single position. Now most traders want to make billions in one day, and that is why they don't use good risk management, because risk management only limits how much you're going to make in a trade. You understand? But with good risk management, trust me, over time you will accumulate millions of dollars from the Forex market. It depends on how patient you are. So why is it critical to protect your capital and to stay in the game? Remember, to stay in the game. The aim is to stay in the game. The aim is not to make billions in one day. Is to stay in the game. I can start trading this week and I'll make more money than someone that wanted to just buy Lambo in one day. Why? Because the person lost a lot of money not using good risk management. But gradually I kept on trading throughout the week and I made profits. So the key practice I want you to understand is never risk too much, or at least risk not more than 1 to 2% of your account. You understand? Also use stop loss. Like I said, stop loss order is a very, very important order as a trader, and I will get to show you how to use stop loss as we move on with the class. So avoid over leveraging. There will be video on how to use leverage, how to use stop loss, how to set up your trading platform, and I'll talk about this on this stop loss, and also this how to also use leverage and how to set your lot size. I'll talk about all this when we are opening our trading platform. You understand? So let's move on with this. Now the next is trading psychology. Now Forex trading is not all about strategy. That's what some traders fail to understand. Forex trading is not all about strategy. We are not coming to the market to get the best strategy. No, Forex trading has a lot of things, and I've talked about most all of them in this video. We've talked about fundamental analysis, We have talked about technical analysis. That's where you see your strategy. We've talked about risk management. I'm talking about trading psychology. Now, psychology is all about controlling your emotions and mindset while trading. It is the mental aspect that influence how you make decisions, handle wins and losses, and stick to your trading plan. And this is a very, very important aspect. Why? Because you have to learn how to control your emotions. You don't stop your emotions, you actually control them. So if you're feeling like you need to make ASAP, you need to make money ASAP from the forex market, what emotion is that? That is greed. When you want to make a lot of money from forex market in one day, that is greed, and that can lead you to losing a lot of money. You understand? You have to stay calm, you have to stay disciplined. So emotional control, we have fear, we have greed. Fear is another thing. Most people don't want to lose money at all, so they get scared and they close the market immediately, and they end up losing potential profits. You understand? So fear and greed is your biggest enemy when it comes to emotions. So you remember, stay calm and stay disciplined. Consistency, follow your trading plan, right? You should have a trading plan, and I'll talk about trading plan as we move on. So avoid impulsive decision. Also, your mindset matters. Mindset is a very, very important key player when it comes to trading psychology. You have to believe, you have to have confidence, you have to know that you're the best, you have to know that yes, that you're doing the right thing. You understand? But you can only have this confidence if you have the right knowledge. So view losses as part of your learning process. I want you to see losses as part of your learning process, not like the market is after you or your village people are after you. No, you have to take your time to learn it, and you have to take your time to make profit. So let's go on to the next one: forex brokers and platforms. So now, forex broker and platform is something I'll talk about as we go on to the next video. But I want you to understand that choosing a broker, you have to be looking for a broker with low spread. Spread has to be low, because why? You don't want to be losing so much money to your broker. You understand? Let's say you enter a trade that's supposed to give you $6, but your broker takes $3 out of your $6. They are sharing half of your profit with you, which is actually very, very bad. So you should be looking for brokers that have low spread, so you can, make good profits from each trade. Please, fast execution. Also, brokers determines how fast your executions are placed. So also good customer service. Broker, remember, is the platform at which you deposit your money in order to place trade. So they have to have good customer service. Why? Customer support. Why? Because in case you have problem with your money or with you placing a trade, you can easily call them and they'll be able to answer you. Now, trading platform. Now, the difference between a broker and a trading platform is like a trading platform is where you place the trade, is where you buy and sell. While a broker is where you deposit your money. You understand? So a broker and a trading platform, they work hand in hand. So you deposit your money first of all in a broker, you connect it to your trading platform, and then you place the trade in your trading platform. So your trading platform, we have the MetaTrader 4, and we also have the MetaTrader 5, and also we have TradingView. Now, I will be showing you all how to use MetaTrader 5 and also TradingView. You understand? That is the two apps I'll be showing you all how to use and how to use it perfectly as a beginner trader. So you have demo versus live trading. Now I want you to understand that demo account is just a practice risk-free account. It means it's visual money. You're using a fake money to trade. Now this is a very, very important account. Why? Because every trader needs to practice first of all before they move into a battlefield. You understand? Before you go into a battlefield, you need to practice, and the only way you can practice is by trading a demo account. So I wouldn't advise any beginner trader to just go and jump in straight into a live account. You understand? Before my students even go into a live account, they must have gotten their strategy. They must have passed through 10 different challenges, right? They must have gotten their certificates after they have passed their exam. You see the long process I make them go through. Why? Because I want them to be professional traders. You understand? So once they go through this process, I will give them the full authorization to go and open a live account, because I know that you've gotten the right knowledge, you've gotten the right mindset, and you know what to do in order to make more money from the forex market. So building a trading plan, that is the next thing we'll talk about. Now, building a trading plan keeps you disciplined and reduces emotional mistakes. So components of a trading plan, we have trading goals, we have risk management, which are the rules, and we have entries and exit strategies. Trading plan is very important. As a trader, you must have plans in which you want to tackle the market with. You don't just trade any day or any time. I see a lot of traders doing this, and at the end they will say forex trading is a scam or it's gambling. No, you don't just have a trading plan. That is why it's looking like a scam to you. That's why you're gambling. You understand? So that will be the end of the video. That was a long one, and the tips I want to leave you with is forex trading is not a get rich quick scheme. Do not think of forex trading like something once you enter today you make millions in the next week. No, it requires education, requires discipline and practice. You have to practice, you have to learn first of all. You understand that you have to be disciplined. Now I want to tell you this: a lot of money can be made from trading. A lot of money can be made for trading, and if you are willing to learn first of all and be disciplined, you will make that money. I have made millions from trading, no cap. And I'm telling you, for you to make it this far, I can see that yes, you're disciplined and it means you want to make huge amount of money from the forex market. But I need you to learn first. Don't just watch a video and go and start trying to trade. You understand? Practice first, learn first. The right information matters, and also the person you are getting that information from matters. So I'll leave you with this, and I hope you understood this video. In case you have any question, make sure to ask me. I'll be willing to answer you. Have a lovely day.